Good morning, everyone. Thank you for joining us this morning here on our live with CLS Capital. We have the great David Perez. And I say that with excitement because it's been a long time since I've been waiting to bring somebody on like David on board with us and give the value that David brings to the table, show you guys a little bit about that. So, David is not only a master at tax saving, tax strategies, but he is what I have preached a lot about in the past, which is a tax advisor, not a tax accountant, not just a CPA, but a tax advisor. This is someone who you come to that helps you strategically plan around your business model to better be able to save on your taxes and better yet, be able to better understand them so that you in the future can use those strategies and build upon them, right? So, David, welcome. Thank you for joining us. I would like for you to formally introduce yourself. Tell us a little bit more
But
about what you do.
yes, but before that, we are gonna say thank you for everyone that who is connecting right now this time. Uh, to our parceros de real estate, muchas gracias por todos los que están conectados el día de hoy. Esto ha sido para nosotros una bendición poder tener este invitado el día de hoy porque es una persona, para mí es una eminencia, es un maestro en medio de todo este, en el negocio de tax advising. Entonces, ¿por qué no tener una persona así en la comunidad hispana? ¿Por qué no contar con unas personas profesionales que siempre día a día nos están respaldando y también nos están dando las mejores estrategias para que podamos ser mucho más creativos con nuestro negocio, poder maximizar también esa cantidad de dinero que tenemos para nuestras inversiones? Entonces, ahora, mientras que se van conectando las personas y también todos nuestros canales se van conectando, vamos entonces a hacer una breve introducción de David. David nos va a contar entonces de dónde viene y por qué esta pasión. So David, welcome today to Los Parceros de Real Estate.
Thank you. Thank you. Thank you for having me. First and foremost, I guess, where do you want me to begin? Talk about what I do, who I am? Is that where we begin?
Who you are, yes.
Okay. So, well, first off, thank you all for having me. My name is David A. Perez. I am the CEO of several companies, but most notably is Tax Plan Experts. We are a strategy company that helps high-income earners mitigate or eliminate their tax bill using advanced tax strategies. Now, I didn't just wake up one day and have these, skills to help people save on their taxes. In fact, it's been a long career. I've been in the industry of taxation for the last 17 years. For the big majority of it, I was just a tax filer. I help people file their returns. And that was a huge deal because people need to meet deadlines. People need to get their taxes filed accurately. And so for the first 12 years of my career, I spent filing returns. In fact, by 2020, I had filed over 50,000 tax returns. By 2020, I realized that, hey, man, this is a great business. I love helping people, but I knew there had to be more. Now, the interesting thing is back in 2015, I had grown a very successful business, and that really meant that I had to pay taxes. If you guys have ever been successful, you will know that the tax man will come. And in 2015, I had the largest tax bill I'd ever seen, which was over $150,000. And I had to make some tough decisions, right? I had to say, man, how am I going to pay this? What do I need to do to avoid it? And I came to realize by going around and talking to other people that there was no way to avoid it. And that I was a tax professional who really didn't even know what I was doing. So many tax professionals go through the motions, figure out the tax code, but don't really know how to maximize it. And I was one of them. So in 2015, I made a decision that I wanted to save myself on taxes. And so for the next 5 years, I learned how to leverage the tax code. I put the most advanced strategies in place for myself so that by 2020, simultaneously, even though I had a huge business, I was paying zero in taxes. And in 2020, something changed for me in my business, which was COVID. And when COVID hit, a lot of, my business had to go virtual like many of us. And in that moment of going virtual, I realized that there were a lot more clients out there than I had ever seen before. And the reason I realized that is because when I went virtual, people from Florida, California, North Carolina, California were getting on my calendar, asking me to help them file their taxes. And what I realized is that many of them had different challenges. You see, the majority of my clients for the first 12 years of my career were people just needing to file their returns. But the clients that I was meeting online were different. They had tax bills, they had complex returns. And one client in particular asked me to help them file their return. They were from Florida. I looked at his past 2 returns and he had paid over $100,000 to the IRS every single year, the last 2 years at least. And I said, man, can I help you? And he says, what can you do? And with just a few small shifts, I saved him over $70,000 in taxes. And he says to me, man, how did you do that? And I said, well, I kind of just know this stuff. I've been doing it for myself for years, and I just never had the opportunity to do it for somebody else. And in that moment, I realized that for the last, at that point, 12 years, I had been honing down skills that I had just never been able to use. And in 2020, I said, you know what? I don't want to just file taxes anymore. I want to become the advisor that clients need. You see, one of the biggest competitive advantages in any business is being able to say you're your number one customer. And I was. The reason that I've gotten good at what I do today is because every year since 2015, I've had a tax bill that I've had to mitigate. And that's my goal every day, to help my clients. Today, we serve clients all over the country. I also teach accountants how to do the same thing, because a lot of accountants today don't know how to do any of these things. And my mission and passion today is to transform the accounting industry to help clients avoid paying taxes legally and leverage every tax code that is out there. And so today, that's all I do every single day.
Fantastic, David. Thank you so very much. And to those of you guys that are listening, one of the key distinctions is, if you notice what David said, is actually applying legally the tax code so that you pay no taxes, right? And that's the difference between just an accountant who's going to come in and do your taxes the right way, but then you have people like David who take the tax code and leverage it so that you save money, right? At the end of the day, is not necessarily how much you make, but how much you keep. And while one of the things that I noticed about David is he has something that he's made his goal clear, and that is to break the rich trap. David, I took a lot of interest in that word. It was very creative. Can you tell us a little bit about that? What do you mean by it? I know there's a lot of business owners that fall into that, something that I've never really thought about it that way, but it's absolutely true.
So, over the years, what I have come to see and witness is that there are many people who have made money, and money is technically a goal everybody should have. They should strive to make money. Unfortunately, very few people build wealth because they get stuck in what I call rich. You see, rich is supposed to be a temporary place where you generate income, money, and use that money and leverage it. That could be to buy the right investments, so you can do things like buy real estate or invest in assets that have income producing opportunities. And many people miss that, because as income goes up, so do expenses in correlation. So quality of life gets better for most of us when we make more money. And then it becomes the standard of life, right? But yet they stop making more money. Most people cap their income and then align their expenses to that income. And what I believe is that almost every single person in this country has the ability to build wealth. They just get trapped trying to live to maybe even beyond their means, trying to increase the standard of living for themselves and their family, the qualities, while simultaneously trapping themselves in a time for money investment, meaning every day, the only way they can make money is if they show up. And the majority of people don't have to do that, but they get stuck there, because wealth is when you can stop working. Wealth is where you don't need to make money because your money makes money. And unfortunately, nobody teaches that enough. And so most people just get trapped. They think rich is the goal. Rich is not the goal. Wealthy is the goal. And wealth is where your income or your passive income exceeds your liabilities and your lifestyle. And very few people will ever get there, because it will always be equal to liabilities. And that's what I've noticed, right? And so that's the concept that I found a few years ago when I was trying to figure out how I would build wealth, or how I could help my clients go to another level. And that's what I call escaping the rich trap.
Fantastic. Thank you for explaining that, David. And you've put it in a very catchy term so that it catches people's attention, which I really love, because this is something that a lot of people fall into. What I have found is that a lot of people fall into this trap with the belief that they own an LLC and therefore it's a company and that's the way it's supposed to work. But then they don't push forward further, right? In knowing how to create the right process procedures that it takes so that you can actually create wealth and have your money essentially work for you rather than you work for your money.
Exactly.
David, one of the things that we often see here at CLS Capital is we have a lot of clients that come from the EIN world, right? Your tax ID type of client. One of the common questions, or one of the things that we have is for them trying to help them out in this venture and the concepts, break through some of the concepts that come from this type of client. Can you tell us what are some of the common mistakes that first-time investors, especially those that come from the EIN world, commonly you see them making that they could potentially very easily correct?
Well, first and foremost, there's the distinction. Are we talking about EIN or ITIN?
IT number.
Because by the way, they're both very similar as they're recognized by the IRS. One's for an individual, one's for a business, but they're very similar in the way that they're treated. So if we're talking about the way people invest in real estate as an ITIN holder or invest in general, there is no differentiator between an ITIN holder and just a normal taxpayer, meaning the mistakes that they make would be the common mistakes everyone would make. Unfortunately, there's like maybe this misunderstanding of this special treatment to an ITIN holder versus someone else. And there is when it comes to credits, there is when it comes to certain things that may be applied to a return. But when we're talking about investment activities, it's the same as all. It's interest income, it's expenses that are ordinary and necessary. It's very similar. So when I think about mistakes that could be made as an investor with an ITIN, the only mistakes that I see the most common are they buy deals or buy investments that just don't generate income. Because the truth is that many people are trying to get tax deductions, but the truth is that tax deductions is not the reason to invest. The reason to invest is to generate income or to build assets that generate wealth. And the majority of people buy real estate today because it's an allure. People are like, oh, it's so exciting to own real estate, and the truth is that many of them don't produce enough money to even service the debt or the taxes and the insurance. And so they get a tax benefit in some cases that is probably not as big as they thought it would be. Plus they have a liability that kind of continues to perpetuate year over year or month over month. So those are big mistakes that I see.
Thank you for that, David.
Thank you, David. Well, we are gonna say hello to the people who is being connecting. Thank you and good morning, Leonor Martínez. Good morning for being here every day. Muchas gracias por siempre estar conectada a nuestros live de los parceros del real estate. También tenemos aquí un saludito y están saludando. César está saludando a good morning, Jean and David. Thank you for sharing all your information with our community. También tenemos a la señora Torres, María, dice good morning. Muchísimas gracias a todos los que se están conectando y recuerden de estar súper activos aquí y de aprovechar para dejar sus preguntas. Ya veo que tenemos una pregunta de Alex Maldonado. Entonces, ¿tú la puedes leer, por favor, Juan Carlos?
Absolutely. So, David, how do you suggest the audience vets the right professional that can provide the level of support you described? Well, that way they can avoid unintended consequences in the future.
Well, first and foremost, if you're trying to avoid mistakes in any area of life, you should always find people who have the knowledge and experience. And so here's the credentials that most people don't look into before they start working with any professional. You see, if you're going to go and let's say work with a financial advisor, the first thing you should ask the advisor is how much money do you have invested in the same assets that you're asking me to invest in, right? If many people try to help clients or potential clients in a way that they can't even help themselves. And so the reason that I have a unique perspective on things is because I'm a real estate investor, right? We own about $10 million worth of assets personally. And
Right.
so when somebody comes to me, they're like, well, how do you know so much? Because I'm in the game. I'm not talking about the game, right? I didn't go to work to try to teach this. I mean, I didn't go to school to learn this. I actually do the activity that gets people and myself the results. I'm my own client. And so the first level of question shouldn't be, oh, are you a CPA? You know, doesn't mean anything. If they say I'm an enrolled agent, it doesn't mean anything. If they say they know it doesn't mean anything. It's what have you done? And who have you done it for? And if they can't even say it for themselves, you know, it's like going to a real estate agent. One of my biggest challenges with like real estate agents is they're like, we help investors. I'm like, what did you invest in?
Right.
like, tell me how you know that this is a good deal other than you're going to get a commission.
Yeah.
Right. If it was such a good deal, why aren't you buying it? Right.
No, absolutely. I think that's something that is missed a lot of times. You can tell me that you have all the credentials. It's similar to going to school, right? In school, you're being taught theory, but your professor that taught it to you typically doesn't know, has never practiced that theory, right? And I think you can take that and apply it to the business world. Well, who you want to partner up with in this case, because the way I look at things, if I come to you, we're partnering up. I am saying, I need your services because I trust you, right? So I'm going to vet you and say, what have you done? I'm going to look at you to make sure that you've done what I'm asking you to do, or that what you're telling me to do is vice versa. And I think that's a really good way to look at it, not just for any profession, right?
That goes to everything, man. When you go to the doctor and your doctor tells you need to take care of your health, and you look at your doctor and the doctor's overweight, unfortunately, I would not be listening to that doctor. Like, I'm sorry, but the truth is like, you can't give me advice on something you can't do.
Absolutely.
Right? You just can't. And unfortunately, in the world we are, especially in the Hispanic community, a lot of people just believe in people too much because of the credibility that they're given through either some certification or some position. And the truth is that because that's the authority, right? So there's two ways to get authority. You get it either through the stroke of a pen, a certification, a designation, or through respect that's earned by doing the thing, right? And I want the respect that's earned rather than the one that's given. So I'm an enrolled agent. I have a designation, but that doesn't mean anything. Like I don't even remember anything on the test. Like, who cares? But I know how to do deals.
Yeah.
And that's what you're looking at. One of the things that I think makes us different here as well is, from Natalia to my wife and myself, that's something we've done. And I think that some of our agents as well, some of our loan officers are doing the real estate investment side as well. And so we've always taken that kind of heart. But yes, it actually applies to everything you do.
Yep, that's what we need to do, guys. And as a real estate investor today, looking at deals today, knowing what's in the market, I can help my clients in a deeper way.
Correct. And I think that brings up a really good point that we often miss. It's a lot of people go out and make deals, right? And as a real estate investor, they're trying to see everything. But you just said something that kind of struck a chord in me. What a lot of people miss is actually the market, right? Because you're doing it, you're understanding the market, and because you're doing it, it forces to look at the market. And that is one of the critical aspects to real estate investing generally, right? Learn the market, understand it, know what it is. And that's something that, especially in the Hispanic community, we often take for granted. And at the same time, when you find a lot of uncertainty in a deal, it's because you don't understand the market. That automatically tells me, like, well, why do you have so much uncertainty if you worked out the numbers? But what's really hidden there is I don't understand the market of what's going on here.
That's correct. What's interesting in the Hispanic community specifically, actually, it's almost all communities, but especially with ITIN holders, is that the majority of them are trying to get into deals in most cases with cash. And that's a huge deal. And a lot of that has a lot to do with, this belief that they can obtain financing. That's why you guys play a big factor. But in addition to that, this belief that debt is bad, right? So there's these two contending things. And what I like to look at deals today is I want to find a deal that I can 100% leverage. I mean, I can borrow 100% financing. Obviously, that's not always the case. But the more that I can get closer to no money out of pocket and the deal still makes sense, the more likely this is a good deal. And that's how I evaluate every deal. I say, if I went in this with zero money out of my pocket, would this deal make sense? No. Okay, so how much money do I have to come out of pocket to make this deal work? Because every deal works with enough money. Right. Every deal works with enough money. The challenge is, how much capital outlay do I have to give in order for that deal to make sense? And then how fast can I recoup that money? Now, if you can tell that I'm just talking about deals from an investor standpoint, but then immediately after I can make the deal make sense, the secondary topic for me or statement is, how much tax benefit do I get from this? And then that then becomes the like, oh, this is icing on the cake. It's not the cake. The cake is the deal. Icing on the cake is the tax savings.
Absolutely. And I think that should be something that everybody looks at, right? Because the tax aspect of things is probably the secondary most important thing, other than making money within the deal, right? For it to be the right deal. Otherwise, you're going to be paying Uncle Sam a whole lot of money. You mentioned something which is key to a lot of the things that we've done in the past as far as real estate investors, and that is leveraging the deal so that you don't come out with a lot of money out of pocket, but also, how does the tax implications apply to that when you leverage or borrow money? Can you walk us through that a little bit, David? How does borrowing money for the deal actually help you out on the long-term tax wise?
Very, very good question, because here's the biggest misunderstanding about tax benefits with real estate. A lot of people will buy real estate thinking they're getting an 100% deduction. So for an example, you buy just for simple math, you buy $100,000 property, and there's an assumption, like just the assumption, because nobody really gets this, is that there's $100,000 deduction. So for an example, if my income was $100,000 and I bought $100,000 piece of property, automatically I have saved all my taxes. That is a very big misconception. And I see that every day. That's why people buy real estate, because they're like, well, I made $300,000. So if I buy a $300,000 property, oh, it's automatically I pay no taxes. The thing there is that the reason you buy real estate, number one, is because you can leverage it, meaning you're not going to get 100% deduction. So you should never put 100% of the money. Because if you put 100% of the money, you don't get 100% deduction, which means that you're still going to have some tax bill, which I see a lot of people do. They say, I made 300, I put 300 into a deal, so now I get 100% deduction. They don't, and there's still a tax bill, and they put all of their money into this transaction, and now they don't have money to pay their taxes. And it was a misunderstanding because they didn't get this. So when you buy real estate, let's talk about just how the math works. If I buy a $100,000 property, let's assume that that's going to be on my tax return. Immediately, I put it on there, and the IRS will reduce the investment by the land cost. And for this case, we'll just use $10,000 as the cost of the land, although it probably is greater than that. Like, it's typically 20%, but I'll just use 10% in this case. So I only have $90,000 as a starting deduction. So I have $90,000. The second part about that is the IRS has what we call depreciation, which everybody talks about, and it's like a big deal. But depreciation is a paper deduction that is allowed by the IRS, and it's typically calculated on a years of schedule, and they call it a depreciation schedule.
Right.
Now, IRS code says for single family residents, the depreciation schedule is 27 and a half years. Okay, so I'll do the math real quick. I get $90,000 and I divide it by 27.5, and I'm going to get a $3,272 deduction on my tax return for the next 27 years. Okay, so check this out. If I bought that property cash, I'm only going to get $3,200 as a deduction on my tax return. Now, by the way, that's a deduction. That's not tax savings. Your tax savings would be calculated, your tax rate, which everybody has a different one. Let's just use 20%. So you multiply the 3,200 times 20%. So you get $640 of tax savings because you bought a $100,000 property. So people are like, what, David? Like, that's it? I'm like, yeah, that's it. That's it. And then they say, well, I hear all these social media influencers and every YouTube video, and everybody wants me to buy real estate because the tax benefits are the greatest. I'm like, well, you just put $100,000 in cash on getting a $90,000 deduction that you can only take over 27 years. Like, you save $640 in taxes, but you spent $100,000. So the tax benefits were not good, but maybe the deal is. I'm not saying the deal was bad. I would just say that the benefits are wrong. So really where I see the challenge is that many people believe that the tax benefits are greater than they are.
Correct. And thank you for saying that. And this is where borrowing money and where good debt, where as we spoke earlier, you don't want to get into bad, that all debt is bad. It's not. This is where you actually leverage good debt so that you can maximize those. And you're not taking all your cash and putting it somewhere where you're not going to get it for 27 and a half years.
So just so we're going, let's go back to the debt component now. The reason that you should finance it is because in one scenario, if you go cash, you put $100,000 to get a $90,000 deduction over 27 and a half years. Every dollar less than 90,000 is a better investment. Meaning if I get down to 20% down, now I'm at 20,000 that I put out of my pocket. Now the deduction is still not good, but it's better than me putting 100,000. Right? So it just makes more sense to put less money in the deal if the tax benefits are going to be the same.
Correct.
If the tax benefits are the same, why would I want to put cash? Mm-hmm. So you want to borrow. But if you are borrowing, then you have to look at it from the investor angle, if that makes sense, right? So you have two components. You have to look at it either from taxes or investor. So I look at it as investor first, taxes second. And so you look at it and does this deal make sense? How much money do I have to put out of pocket for the investment to make, financial sense for me to get a return at some point? And then it's like, oh, okay, so I could do it at this number. Now, if I do this investment, how much tax benefit am I going to get? I'm only going to get $640 in tax savings per year. Whew, man, I expect my tax bill to be bigger. So I don't know if that's the right move, right? So you have to look at it two ways.
Well, thank you. Yes.
So that's what we say. That's what we say. Always use other people's money, right? So that's why CLS Capital is here to help all the investors here to be able to do these investments from the smart way, right? So I want to say thank you for the people who have been connecting and say good morning to everyone. Hola amigos, saludos. El señor Francisco Villavicencio, muchas gracias por estar aquí conectados siempre. Tenemos a Erika, buenos días, están saludando. Tenemos también a Erika, tú que haces esas preguntas, Triqui, por favor, ahí espero una de tus preguntas. María de Jesús Guzmán, muy buenos días, gracias por la información tan valiosa. Tenemos a la señora Leonor Martínez, muy buenos días, muy buena información está diciendo. También dice, es muy cierto, dice la señora Leonor Martínez. También Alex Maldonado está dando las gracias por la información y por nosotros poner toda esta buena información a la comunidad y dar las gracias a David y al team de David. Tenemos también aquí conectado a Alma. Alma, muy buenos días. Muchas gracias por estar aquí conectada y dispuesta siempre a aprender. Muchas gracias por todos los que están siendo conectados y cada vez están sumando más, porque esta es la hora, el pico que todos estamos ya dispuestos a escuchar y aprender de todo. Bueno, entonces aquí viene una pregunta, Juan, una pregunta que le hace el señor José Tejada a David.
Go for it.
When is the best time to do cost segregation in the new construction rental builder this year and refinance cash out already?
So first and foremost, let's go to the second tier of tax strategy. So we first have evaluated a property. We purchased the property for $100,000. We then have shown that normal depreciation would be, $3,200 and $640 in tax savings. Now, if we want to add a tax strategy to that, we could add maybe a cost segregation. Now, cost segregation studies, for those of you who don't know this, is basically the IRS says that residential properties are 27 and a half years. Now, there are other sections of the IRS code that allow for depreciation to be moved forward, like what we call accelerated. And the way that you accelerate depreciation is you identify or classify the asset in a different way. So right now, as it stands in our example, the asset is classified as a residential structure. So what we do is we say to the IRS, we don't want to classify this as a residential structure. We want to classify it as its individualized components. Now, to go back to the schedule of 27 and a half years, on that same schedule, the IRS will list out every single asset that can be deducted on a tax return. And that could be computers, cell phones, trucks or vehicle, heavy equipment. But it also goes into detailed items like door handles, windows, shingles, trim, sheetrock, tile, vanities, all these things, right? And so what we do is we run a study on a property, and the study is done by an engineer and an accountant. And what they do is they evaluate the property and they say, oh, okay, let's go look at the property. And then they look around, they're like, oh, okay, so we have this many pieces of sheetrock. We have this type of baseboard. We have this type of, tile. And they literally identify every single asset that the property is made of, including the concrete and the framing and everything. And then we take that list and we apply it to the schedule that the IRS has published, and we align the item with the schedule. And so we say things like sheetrock, and we say, studs, and we say door handles. And then we say, okay, so these items fall into the 5-year category of depreciation, 3-year category of depreciation, 1-year category of depreciation. And then what we do is we say all of these items now can move faster. And then we take additional tax code that says maybe you could take a lot more in year 1. So on average, we can use a cost seg study like I just notated and accelerate on average 30% of the structural value in year 1. So as an example, in the 100,000, we subtract the land for 10, we've got 90,000. We multiply that times 30%. So 30% of 90,000 is $27,000. So now we take a $27,000 deduction. Just to be clear, this isn't going dollar for dollar against your tax bill. It's going to reduce your income by $27,000. Now, this is a strategy that you would employ if you wanted to use real estate to get bigger tax savings. However, just to be clear, that $27,000 in the same example would only give you, if you're in the tax bracket of, let's say, 20%, would only give you $5,400 in tax savings. Okay. So it's not that big either, right? $5,400. Well, I mean, I guess it could be, but I mean, if you're buying real estate at a high level, your income and your tax bill is greater than $5,400, just to be clear. So it's not going to be that impactful to a lot of people. But to do cost segregation studies, it only makes sense. It only makes sense if real estate is your primary activity, meaning you are not a business owner. You are not a W-2 earner. You're not somebody who has a job or business activity. And let me tell you why. In most cases, you cannot qualify to accelerate depreciation because real estate is a passive activity to you. And if you are a passive investor, you have other activities that you perform every single day, not just real estate investing, then even if you had a $27,000 loss on your tax return, it would not offset your everyday ordinary income because passive activities like real estate are classified as passive income or passive losses, which means the only thing that it could offset, meaning reduce, is other types of passive income, which you may not have. So this is the biggest lie. Let me put this in big lie. The biggest lie sold to real estate investors 4 tax benefits is that they can reduce their ordinary income by buying real estate. And the truth is you can't unless there's 3 categories that you fall into, and we can talk about that next, but most people can't, especially those who are just investors. Meaning if you're going to go put money into a syndicated deal, like somebody's buying apartments and you're like, I'll put 100 in, wouldn't benefit you at all. If you put it into a property as a partner and you're like, I'll put up the money, you do the work, you're a passive investor, would not benefit you at all. You actually have to materially participate and be actively involved and make this your primary activity for this to even be mentionable. So I would never recommend cost segregation to everyone, because the truth is you could be paying $2,000 or $3,000 to do a cost segregation study, and it would never even move the needle for you. You'd be upset.
Now, that being said, the gentleman who asked this question, Jose, he is actually very much involved in them. So for him, everything that he's doing would make cost segregation would make sense.
Ok, entonces a la comunidad les quiero decir algo, algo de lo que está diciendo David, quiero resaltar aquí. Entonces, siempre ustedes deben de estar siempre asesorados de su tax advisor, y siempre, por favor, ellos deben de entender esta actividad y ser inversionistas ante todo para poder entender este código. Y una de las cosas que resalta David aquí es que para poder ustedes tener la mayor, sacar el mayor provecho en los taxes, no es siendo un inversionista pasivo. Entonces debe ser un inversionista activo para poder tener mayor ventaja aquí en su declaración de impuestos para sus deducciones. Ahora tenemos una pregunta de Erika Salgado, Juan.
Okay. David, what strategies can we use to reduce or eliminate capital gains when selling a property? Do these differ when selling a flip versus new construction?
Well, first and foremost, capital gains are only on capital assets. So if you're doing flipping and the property is transacting within a given 18, 20, let's say less than 24 months, in most cases, that is a business and not investing. So you're not an investor. You were just running a business, as if you were to buy if you bought cell phones and flipped them, or if you bought a computer and flipped it, or couches and flipped it, it's the same concept, even though it may feel like it's a different transaction because it's such a big transaction. There is no difference. You are treated as a small business. Your inventory is the property, and the property will be sold for a profit. That gain is ordinary income. Capital gains only happen when you hold an investment activity, right? So if you're going to hold it as an investment and then sell it in the future, then that is called a capital gain. Now, to avoid capital gains, there's a few ways, but I'll tell you the most common is to do a 1031 exchange into another deal, meaning you take the profits that would be given to you from this property and roll them into another property. Challenge with that is, when I say that, it has to be handled by a 1031 company. This is not something you just take the profits, go and play with them for a little while, then put them in something else. The profits truly have to roll into the next transaction. There's a lot of limitations. There's a lot of special circumstances. You have to work with a professional to do this. Do not think that it is just as simple putting it. It literally is, you have to work with a 1031 professional. Number two, there are other offset strategies. We do have access to some strategies that I don't want to get into in to extent, but if you have a capital gain, just to be clear, greater than $500,000 right now, I can make that disappear. But it has to be greater than 500,000. Anything under 500,000, let me just tell you, 1031 is probably the best way to do it. Best way to do it. An alternative to that could be to take the capital gain, and then you'll have to pay taxes, or it's going to be taxable. Let me put it in that context. And then buy a larger property very quickly, because then you would take the cost seg and it would mitigate the gain. But that is a very risky process, because if you don't identify a big enough property, or you don't do it soon enough, you're going to be liable for those gains.
Thank you for that. And to piggyback on what David said as well, one of the reasons that you'll see seasoned investors that know how to differentiate between these two, they don't put their flips in the same LLC or whatever structure of company you have, where you're doing both flip, new construction, um, and rental investment properties in them, because they're treated completely different, and risk is completely different, right? So it's all about risk management. That's one of the biggest reasons that, as David mentioned, that's one of the biggest reasons why you want to separate them, because at the end of the day, for tax purposes, they're looked at completely different.
So for context, and that's great that you pointed it out. Now, I am not a lawyer, nor will I give legal advice, but I will tell you from a tax perspective, activities need to be in their own entities. Meaning, if you're doing fix and flips or even new construction flips, because that's the same thing, guys. Even though you may not see it, it's the same thing. That's one entity. If you're doing long-term holds, you would put that in a separate entity. They're different in the way they are taxed. If you have a construction business, that is its separate entity. If you have a construction business and you have a home management company, that home management company is a separate company. You separate these things, not just for legal protection, although that is highly recommended by most attorneys. I'm not one, but I would tell you that that's what my attorney would say. Here's what the reason we're saying this: it makes things clean when it comes to taxes. And that's the most important thing, because if I can identify the type of income, where it came from, and what it was for, I can mitigate that. But if you just come and say, well, look, I've been running all my businesses out of your last name, LLC, because that's usually what you do, and now I have to decipher what you've done, it makes it very difficult for us to do it legitimately. And then it puts a risk about it.
Perfect. Thank you very much for that.
So, David, I had a question for you. So, when you said, for example, I have my investment company. With that company, I buy properties, right? But I hold that property. Should I open another company to manage those company if I'm not using any property management?
So I'm not an attorney.
Okay, yeah.
But if I was an attorney, I would say that yes, that is the way to do it.
Okay, perfect. Thank you, David.
But I would consult with your attorney.
Yes, absolutely.
Absolutely. So this brings me on to the next segment, David, and that is partnership and scaling. Is there any benefits, or how does having partnerships with other investors help in tax exposure as you're growing those businesses and those companies? Is there a benefit to it?
Partnerships don't necessarily guarantee any benefit. I mean, first and foremost, I don't want to discourage anybody from investing in real estate. By no means am I saying that the benefits suck. Here's what I will tell you. There is always a tax benefit when investing in real estate. Always, okay? The problem that persists is it's in some cases not immediate. And that is where people get discouraged. You don't get the tax savings immediately. You may get them over time, like I mentioned, 27 and a half years. Or you may get them when you sell the property because you didn't take the accelerated depreciation. So when you sell the property, there's less of a gain. There are benefits to real estate no matter what. The difference that I see today, or the nuance that I see, the difference in what people see it, is everybody wants it immediate. And that's not always going to happen. This is case in point with partnerships. When you bring partners into the mix, there's a very likelihood that there's not going to be any immediate tax benefit that is meaningful. And the reason is because you have to materially participate in order for you to get the big tax benefits. And it's very difficult for everyone to meet that. Actually, not everyone can. It's only one person, one partner. Not every partner can meet it. And so it has to be, I mean, there may be cases where we could justify two partners meeting it, but it's rare. It's very, very rare. And if there was an audit, the IRS would want to know, okay, who's doing what, how many hours did they do it, who actually did more hours than the other, because it's never 50-50. It's never 25, 25, 25, 25. It's typically somebody has money and somebody likes to work. That's usually how partners work, right?
Right.
Because rarely, if people had a lot of money, the only reason they would come together is to buy bigger deals. That's it, right? That's the only reason. But that's seldom the case, because most people just want, and if that's the case, there's always somebody who's going to work, manage the deal, and there's always going to be an investor. So partnerships rarely lead to big tax benefits, honest truth.
Perfect. Thank you for that, David. And finally, coming up to the last segment, let's talk about end of year tax strategies that we could potentially implement this late in the year, if any. Is there any suggestions that you might have for those investors who haven't thought about doing any talking to a tax advisor this whole year or previous?
Well, first and foremost, for real estate, you got to close a deal, a transaction by the end of the year, and you have to also place it in service. So if you guys are under contract or something with somebody, let's close that thing up as fast as possible, because you actually have to place it in service. So if it's already rented, that's already in service. But if it's a vacant property or a new construction, you have to have closed on the deal. A certificate of occupants must be placed, and then the renter must be either in the process of moving in or have signed or solidified a contract, right? So it has to happen before the end of the year for that property to even qualify. Now, from a cost segregation study, you don't have to hit that before the end of the year. Cost segregation studies can be filed anytime throughout next year, before the deadline, obviously, because the deadline is what we record. So you could do a cost segregation study before April 15th. So you have time to do that. So there's no rush to do cost seg. All the cost seg companies right now are on vacation anyway, so it wouldn't matter. So it wouldn't matter. Now, other than real estate, there are a few strategies that you can be used, or that can mitigate your taxes, but your income must be greater than, in most cases, $500,000. If you have a $500,000 net profit or taxable income, we can help. They wouldn't be real estate related, but if you were interested, or any of your audience has those things, we can help right now. The larger the income, the larger the liability, the easier it is for us to mitigate. Anything under 500,000, to be honest with you, the biggest things you can do is just make sure your bookkeeping's up to date. If you got to buy or make any major purchases for your business that you're going to make anyways next year, if you have the extra cash, make those investments right now: equipment, machinery, vehicles, prepay expenses that may be related to the future year, marketing expenses that you can prepay, things that you could give away right now is very important. Other than that, guys, I mean, all the stuff you see on TV and Instagram and stuff about, paying your kids, and a lot of that stuff is good. It just takes time to do it. It may be too late in the year to do it.
Yes, absolutely. So I think that we have more time. We have two more last questions.
I can answer 2 questions, but I have a hard stop, guys, in 6 minutes.
Okay, so
Pick one.
Okay, which one? Juan, Alex Maldonado. We have another one. Okay, let's see. Since we are on the topic, can you also touch on depreciation recapture?
Great question. So depreciation recapture, first and foremost, almost every tax strategy, doesn't matter if it's real estate or not, is what we call a deferred strategy. Almost every single one of them, meaning if we work to save you taxes today, we're basically kicking the can down the road to get taxed later. Everybody's doing it. When people talk about depreciation recapture, everybody talks about it like it's the worst thing ever. And I'm like, have you ever contributed to a retirement account? They say, yeah. And I'm like, that is a form of recapture in the future. They are going to tax you in the future. So when I tell people recapture, that's why you have 1031 exchanges, number one. That's why you have other investment strategies, like you could buy bigger properties or other properties, or you can use other strategies, right? Charitable finance deductions, solar equity tax credits, or I have a bunch of other credits, things that we can use. Recapture should never prevent somebody from buying real estate if you're working with a tax advisor. If you're not, it should be the scariest thing in the world because you don't know what to do. But if you're working with me or somebody who knows this stuff, this would not be a problem. And every conference I speak at, every event I go to, there's always somebody who is, let's just be real, negative Nancy or whatever, and says, but
Yeah.
what about recapture, bro? Why would you buy real estate? And I'm like, look, anytime you defer a tax, it's somewhat of a form of recapture. Everybody's going to go through it. So that should not be a deterrent or should not be a problem, because you can find ways to mitigate that. What we are trying to do in a tax advisor role for you is to let you keep more of your money today, because even if I have to pay the tax in 10 years, I still got to invest the money I had today, which will have compounded for 10 years. So my net, meaning how much money I make, is still going to be more than even if I have to pay the capture back, the recapture. So we're playing long games, guys. This isn't the short game. This isn't little tax stuff. This is big stuff. And so anybody who gets stuck in the recapture world, unfortunately, you're just not working with the right professional.
David, thank you so much for saying
Thank you,
that.
David.
I think that's very important to know. I think it's very important to know that, and keep in mind, as a real estate investor in any business, you're looking at long term. You know, people expect results in 1 to 2 years, but reality even takes 3 years for you to iron out some of the beginning stages of a business, much less seeing some of the long term results of benefits of taxes and strategies and planning. David, thank you so very much for joining us today. It has been a true pleasure.
I want to, if you give me a second, I just want to tell everybody, and we only spent a little bit of time together. I actually have a full training module on just real estate as an investment strategy, and you guys have been so good to me. If you guys don't mind it, this thing is normally $1,000. If you don't mind, I'll drop the link. It's $97. It's about 8 hours of real estate investing strategies and how to maximize them. If you guys can I offer that to your audience for $97?
Yes, absolutely. Mm-hmm.
Yeah, absolutely. So let's drop it in the chat here. Team, I don't know if my team has access. I don't know if I can.
Yes, it's here on the chat. Yes, it's here on the Facebook chat.
Okay.
You can get access here. Mm-hmm. This is the link that you can.
There you go.
Access.
Yeah. So if we could just drop that in there, if anybody would like to get access or drop the code, it's there you go. Thank you. It's $97. It's a no brainer. It's tax deductible. People always ask me if they could get deeper with me. You know, obviously I have a lot to do by the end of the year. If you wanted to learn a lot, you could do that. If you, by chance, by the way, if you do have a tax liability that is pretty significant, let's say 250,000 or greater, and you have no options, go to taxplanexperts.com, and fill out an application. We do have a few strategies that are accessible right now that can be mitigated on taxes. And I'm telling you, if you really want to make your bill disappear this year, I can help you. But you have to have a big enough bill. Just be real. So if you guys need help, I can help you. And if you want to get access to the training, join.taxmaverick.com/CLS.
David, thank you so very much. Guys, I cannot speak highly enough of David. If this is something that everybody should be interested in learning a little bit more, and highly encourage everybody to join David in the class. David, true pleasure. Thank you for your time. Greatly appreciate it. Absolutely.
Natalia, thank you guys. Wishing you all success.
See you next time.
Bye, guys. Thank you. Bye.